We often hear about the superhighways of investing, right? The huge stock markets, government bonds. That's where most of the money is.
Right, the big, obvious places.
Exactly, where everything's supposed to be super efficient. But what if the really interesting stuff, the chance to find real value isn't there?
What if it's off the beaten path?
Yeah, tucked away in these back alleys of the market. Instruments or strategies that just seem, I don't know, too complicated, too niche.
This whole idea of finding alpha in the margins, it's a really powerful concept.
It totally changes how you look at things, doesn't it?
It really does. Because, look, those main markets, incredibly efficient, sure, but that efficiency isn't spread evenly everywhere.
Ah, okay, so there are still pockets.
Exactly. Pockets where maybe information doesn't travel as fast or there isn't as much trading, or honestly, the things being traded are just plain complex.
And that complexity itself kind of acts as a barrier.
Yeah, it slows things down, stops the quick, easy analysis. And that's where inefficiencies might hang around just long enough for someone sharp to spot them.
And that is precisely what we're digging into today in this deep dive. We've got a bunch of sources lined up to take us into these less followed areas.
Okay, what have we got?
So there's an article featuring an expert from Fourier Asset Management. They specialize in exactly this, finding opportunities in niches, specifically convertible bonds.
Ah, convertibles. Interesting space.
And then we have some really detailed excerpts from a big textbook. Covers active equity stuff, quant strategies, market structure, different hedge fund approaches.
And comprehensive. Distressed securities, maybe, things like that.
Distress is in there too. So it's this great mix, right? We get the hands-on view from someone in the trenches of one niche.
The Fourier perspective on convertibles.
Right. And then we zoom out to get the bigger picture. The tools, the frameworks, the analysis that applies across lots of these find alpha somewhere else strategies.
That's a good combination. Specifics and the general theory.
So our mission for you today, we want to really unpack these sources, figure out what these marginal opportunities actually look like. What are these things? Why do these little pockets of inefficiency even exist?
And how do people try to actually capture value there? The tools, the data, the risk.
Exactly. The sophisticated techniques, the data you need, how you manage the risk. Think of it as getting a peek behind the curtain, a shortcut to understanding some of the really complex corners of investing.
Yeah, and appreciating that sometimes the skill isn't just having a brilliant idea, but actually having the setup, the infrastructure to execute it in places others just can't reach easily.
Okay, let's unpack this. Starting with those instruments the Fourier expert focuses on. The source called them the forgotten children of the capital structure. Convertible securities. What are they and why look there?
Right, so convertibles. Based on the sources, they're essentially these hybrid things, usually a bond, sometimes preferred stock.
Hybrid.
Well, the key thing is the convertible part. It gives the holder the right, not the obligation, but the right to swap it for a set number of shares of the company's common stock.
Ah, okay. So you can turn it into stock later.
Exactly, at a specific price or ratio. So
Yeah.
when you first buy it, it acts a lot like a regular bond. It pays a coupon, has a maturity date, you worry about the company's credit risk, all that standard bond stuff.
Okay, so it is a bond.
It is, but with this extra kicker, that conversion feature. It's basically like having a call option on the company's stock built right in.
Ah, I see. So its value isn't just about interest rates and credit.
Right. It's also tied to the stock price, how it moves, how volatile it is, just like an option. So you've got this mix of bond characteristics and equity option characteristics all rolled into one security. That's what makes them, well, complex.
And I guess that complexity is why it's kind of a niche market.
Oh, absolutely. And the source gives us some numbers on that. Calls it a much smaller, thinner market. How using trace data? The daily trading volume in U.S. dollar convertibles. It's only about 5% of the volume in the overall U.S. dollar corporate bond market.
Wow, 5%. That's tiny compared to corporate bonds, let alone stocks.
Exactly. Think about how massive the stock market is, then corporate bonds. And then this is just a sliver of that. It gives you a real sense of how specialized it is. It's not where the giant trading desks are parking huge amounts of money every day.
5%. That really hits home. It means there just aren't that many people playing in that sandbox.
And that's the core idea from the Fourier expert. That specific feature, smaller market, less participation, can actually mean opportunity if, and it's a big if, you know what you're doing.
How so?
Well, think about, say, large U.S. stocks. Millions of eyes are watching, analyzing the same news instantly. Any tiny mispricing gets jumped on and disappears like that.
Right, markets are efficient.
Highly efficient there. But in a market that's only 5% the size of the corporate bond market, there's just less competition. Fewer eyes.
So prices might not adjust as quickly or reflect everything perfectly.
Potentially, yeah. Or maybe temporary supply and demand swings can push prices out of whack for a bit longer.
Yes.
There's just less pressure of forcing prices back into line immediately.
So the things that make it unattractive for the big players, the complexity, the lower volume, that's actually the source of the potential edge for specialists.
That's the theory, yes. The potential reward for doing the hard work. But, and the expert is really clear about this, there's a huge challenge that comes with this niche. The data.
Yeah, the data.
You literally say the data in the convertible market is often dirty or incomplete.
Dirty data. That doesn't sound good. What does that mean practically?
It means getting reliable, consistent info on all the little details of a specific convertible isn't like pulling up a stock quote. You need the coupon, maturity, sure, but also the exact conversion terms, how they adjust for stock splits or dividends, any call options the issuer has, put options you might have, covenants.
Wow, lots of moving parts.
Tons.
Yeah.
And if that data is missing or wrong or different, depending on where you look, your fancy models are just garbage in, garbage out.
So just building the basic information layer is a massive job.
It is. And the 40 expert specifically says their firms spend a lot of time and effort just cleaning and structuring this messy data.
Yeah.
They don't just see it as like a necessary chore.
They see it as an edge.
Exactly. They view getting the data right as a key source of a repeatable edge. Because if the barrier is partly the analysis and partly just getting the accurate data, solving the data problem gives you a huge advantage over people who can't or won't do that heavy lifting.
That's really interesting. So the alpha isn't just a clever trade. It's partly in the foundational work of building clean data.
In these kinds of markets, absolutely. It's step one. If you can't accurately model how this thing pays off under different scenarios, stock price changes, interest rate moves, credit problems, you can't trade it smart or manage the risk.
Okay, so convertibles, complex hybrids, niche market, data challenges, but potential edge there. How do investors actually try to make money from them? The source talks about convertible arbitrage. What's a good idea?
Right, convertible arb. It's a classic relative value play. Usually it's set up as a long-short strategy.
Long-short meaning?
Meaning you buy the convertible bond itself, and at the same time, you short the common stock of the same company.
Okay, so you're not betting on the company doing well or badly overall.
Not directly, no. You're betting on the relationship between the convertible's price and the stock's price.
How they move relative to each other.
Exactly. The convertible price is driven by its bond part and its stock option part. When the stock price is really low, it acts mostly like a bond. As the stock goes up, that conversion option gets more valuable, and the convertible starts tracking the stock more closely, but usually with a bit of a premium.
Because it still has the bond features, like yield.
Right, yield and some downside protection from the bond floor. The arbitrage strategy tries to profit when that theoretical relationship gets out of line. Maybe the convertible looks too cheap compared to where the stock is trading, or maybe too expensive.
So you capture little mispricings.
Yeah, small pricing gaps, plus you typically collect the convertible's yield. And the short stock position is meant to hedge away most of the risk if the overall stock price tanks or soars. You're trying to isolate that relative value piece.
Makes sense conceptually. Hedge the big risk, focus on the small difference. But even with the hedge, it sounds like there's still plenty of risks given the complexity.
Oh, for sure. The sources list them out. First, it's still part bond, right? So you've got interest rate risk, rates go up, the bond value part tends to go down.
Okay, rate risk.
Second, and this is a big one, credit risk. If the company gets into trouble, the bond part can get hammered, and that conversion option might become worthless if the stock collapses too. Your stock hedge doesn't protect you from the company going bust.
Right, the credit risk remains. What about the equity side?
Well, you've got equity risk, but maybe more specifically, volatility risk.
Right.
Because that conversion feature is an option. Its value is sensitive to how volatile the underlying stock is. More volatile. Options theoretically worth more. Less volatile. Worth less. Managing that sensitivity to stock price moves the delta, and volatility, the vega, is crucial. You have to keep adjusting the hedge.
Sounds like constant tinkering.
It can be. Then there's liquidity risk. We said the market's thin. Trying to buy or sell a lot or adjust your hedge quickly can be tough and expensive, especially if the market's stressed and everyone heads for the exits.
And the source mentioned call features as a specific risk.
Yes, that's kind of unique to converts. The company that issued the bond often has the right to call it back, force you to redeem it, usually at a price just above face value.
Why would they do that?
Typically, if the stock price has gone up a lot, making your conversion option really valuable, they might call the bond to force you to convert into stock. This can kind of cap your upside on the trade because you might have to get out earlier than you wanted, maybe before the stock runs even higher. You have to factor that possibility into your models.
Okay, so definitely not simple. Complex strategy, mix of risks, needs careful modeling, active management. How's it actually performed historically? What do the sources say?
Well, the sources look at data from hedge fund indices like HFRI, Hennessy, CSFB Tremont. And the picture they paint is historically pretty positive, actually.
How so?
Returns are described as stable. They quote figures around 11% a year for the period they looked at. And maybe more importantly, the volatility of those returns was generally very low.
Stable returns, low vol, that's usually a good combo. What about how it behaves relative to stocks and bonds?
That's key. Historically, convertible ARB returns have shown low correlation to both stock market and bond markets.
Meaning it doesn't just go up and down with the S&P 500.
Pretty much, yeah. Its returns have tended to move independently. And that's why investors like it. Adding something with low correlation can potentially improve your whole portfolio's risk-adjusted return without just adding more market risk. Diversification benefit.
Did it tend to blow up when stock markets crashed?
Interestingly, the sources specifically say that the historical periods of negative returns for convertible ARB funds were not typically concentrated during big stock market sell-offs.
Huh. So it did offer some protection then?
It suggests it offered some diversification, yeah.
Decoupling from broad market moves, though, again, the credit risk is always there. So overall, the appeal is summed up as stable returns, low volatility, and good diversification potential. And the sources seem to think the reasons for this, the complexity, the data issues, the niche structure are likely to stick around, so the characteristics might be sustainable.
Okay, so convertibles offer one window into this alpha in the margins idea. Complex, data-heavy, relative value. What other areas do the sources point to where similar ideas apply? Finding value in tricky situations. Another major one they discuss is distressed securities investing.
Distressed. So companies in serious trouble. Bankruptcy.
Exactly. Focusing on companies that are in deep financial distress, maybe already in bankruptcy, defaulted on debt, or going through a major restructuring.
Sounds messy. Where's the actual investment angle there?
Usually the opportunity comes because the company's debt bonds, bank loans, sometimes even its stock, is trading way, way below face value, or more importantly, below what investors think they can actually recover in a restructuring or liquidation.
So fear drives the price down really low.
Pretty much. Fear, uncertainty. So distressed investors are basically buying claims on this troubled company. They often try to get involved in the restructuring process, aiming to benefit from the outcome. The goal is to capture the difference between the super low price they paid and what they eventually get back.
Buying for pennies on the dollar, hoping for dimes or quarters.
That's the basic idea of the potential upside, yeah. But it's incredibly complex work. You need serious legal and financial chops. You have to understand the whole debt structure, who's senior, who's junior, what assets back which loans, who gets paid first if things go belly up. And then you have to figure out what the company's assets are really worth.
Which must be incredibly hard if the company is failing.
Extremely hard. And that leads right into the key risks the sources highlight. First, just getting the valuation right is critical and incredibly difficult. What are these troubled assets worth? Is the business model fixable? How much can you really get back from collateral? Get that wrong, and you lose big time.
Makes sense. What else?
Second big risk, timing. How long is your money going to be tied up? These things can involve years of legal fights, bankruptcy court dramas, endless negotiations. Your capital is stuck, illiquid, and you often have no idea when or even if you'll see a resolution.
Right, the uncertainty of the process.
And third, related to that, is mark-to-market risk. Because these securities are often super illiquid, hard to trade, putting a reliable price on them day-to-day is really tough. So their reported values can jump around a lot just based on estimates, even if the underlying situation isn't changing that fast.
Given all that, how do these distressed funds typically operate?
Well, the source says they usually use low leverage, which makes sense, right? The companies themselves are risky enough. They also aim for low volatility returns. But the source cautions, because of those valuation and liquidity issues we just talked about, the actual volatility might be higher than what gets reported sometimes.
And diversification must be huge.
Absolutely critical. The source stresses this, because any single distressed company could end up being worth zero if things go badly. You absolutely have to spread your bets. across different securities in one company, across many different distressed companies, across different industries. It's key to managing that risk of a total wipeout on one position.
Do they try to hedge these bets at all?
Sometimes, yeah. The source mentions they might short other assets or use collateral in specific ways to try and offset some risks, trying to isolate the potential gain from the restructuring itself away from just general market noise.
Okay, so distressed investing is another deep dive. Intense analysis, legal know-how, careful risk management in complex, illiquid situations. It seems like both convertibles and distressed really hinge on understanding the nitty-gritty details.
They absolutely do. And that brings us to a really central theme that pops up again and again in the sources, essential for finding alpha anywhere complex, the critical role of good data and just being able to consistently track what you're looking at.
We talked about dirty data with convertibles. This sounds like a bigger problem than just missing data points.
Oh, much bigger. The Fourier expert hammering on cleaning convertible data really highlights it. Your models are useless if the inputs are junk. And in these niche markets, convertibles, private debt, weird derivatives, whatever the data feeds, just aren't as clean or standardized as for, say, Apple stock.
And the sources really emphasize the challenge of just keeping track of the same asset over time, especially when companies change.
Yes. This is a massive headache in finance, especially for historical analysis or quant modeling. Assets have identifiers, right? HUSIP in the US, ISOON internationally, CEDAL in Europe. These codes identify a specific security issue at a specific time.
But companies merge, split their stock, change name.
Exactly. And the source gives a great example. AIG did a 1-for-20 reverse stock split back in 2009. The ticker probably stayed AIG, but the CUSIP number for the actual common stock, it changed.
So if your database uses CUSIPs...
You suddenly have a break.
Yeah.
The old CUSIP vanishes, a new one appears.
Yeah.
But it's the same company's stock history. If you don't link those two CUSIPs correctly, your history is broken. You might miss data, or worse, introduce survivorship bias, because you only track things that didn't change identifiers.
So how do people get around that? Data providers must have figured this out.
They have. That's why they developed their own permanent identifiers. The source mentions CRSP's PerMeno for U.S. stocks as a key example. A PerMeno sticks with the trading history of that stock, even if USIPs, tickers, or names change. It doesn't get reused.
And they map these permanent IDs to the changing ones.
Exactly. They build these complex mapping tables linking their permanent IDs to CUSIPs, ISINs, etc. over time. That lets researchers build clean, continuous histories without breaks or survivorship bias. Absolutely vital for backtesting strategies or doing any serious historical work.
Seems incredibly complicated. Why not just have one universal permanent ID?
Good question. The source suggests a basic problem. No one fully agrees on what counts as a fundamental change that should trigger a new permanent ID. How do you treat complex mergers, spin-offs, weird debt restructurings? Different data providers make different calls, leading to their own proprietary systems.
Beyond just tracking stocks and bonds, are there other tricky data mapping challenges?
Yeah, the sources mention some cool examples, like mapping patents. Companies often file patents under subsidiary names, not the main company. So if you want to use patent data as a signal, you need smart ways to link them back to the parent firm.
Okay, that makes sense.
Another one is building economic linkage maps, figuring out who supplies whom, who competes with whom, based on clues buried in earnings calls, SEC filings, news. Super important for understanding fundamental connections.
But the source said quants were maybe slower to use these linkage maps. Seems odd for data people.
Well, the reason suggested is that these relationships, how a supplier's problem affects a customer's stock, are often nonlinear.
Not a simple straight line relationship.
Exactly. A lot of basic quant models look for linear patterns. It's much harder to model these complex, shifting, nonlinear dependencies than, say, just using a simple price-to-book ratio. It takes more sophisticated techniques.
So, bottom line, whether it's convertibles, distressed, or broad quant stuff, getting the data right, cleaning it, mapping it, tracking it, building these relationship databases, it's not just admin work, it's fundamental to getting an edge, especially in those murky corners.
Absolutely. Building and maintaining that superior data capability, that's a real barrier to entry and a source of lasting advantage.
Yeah.
You can't even play seriously in these complex games without it.
Okay, speaking of alpha, let's talk about how the sources say you actually find and measure it. We know the basic idea, but let's revisit the definitions. Alpha versus beta.
Right. Fundamental stuff from portfolio theory. Beta is the return you get just for being exposed to the overall market risk, the risk you can't diversify away. Think of it as riding the market wave. An index fund is basically all beta.
Okay, market return. And alpha.
Alpha is the extra bit, the return that isn't explained by that market exposure or other systematic risk factors. It's supposed to be the premium you get from the manager's actual skill. Picking the right stocks, timing things well, executing strategies that beat the market expectation for the risk they took.
Got it. Beta market, alpha skill, and there's a key metric to quantify that skill.
Yeah, the main one discussed is the information ratio, or IR. It's basically the standard measure for risk-adjusted performance, focusing purely on how good the active management part is. The formula they give is IRI equals IC times the square root of N.
IR, IC, score, NTN. Okay, let's break that down. IC, information coefficient.
Right. IC measures the manager's raw forecasting skill. How wide do their predictions, their signals, actually correlate with what happens next? It's usually between -1 and +1. +1 is perfect foresight, 0 is useless.
And how good does IC need to be in reality?
This is interesting. The sources mention that in practice, a monthly IC correlation between this month's forecast and next month's actual return of just 3% or 4%, so 0.03 or 0.04, can actually be enough to run a profitable strategy.
Really?
Yeah.
Only 3-4% correlation? That seems low.
It does feel low, but it shows you don't need to be a miracle worker. You just need a small, consistent edge. Be slightly better than random guessing, have a slightly better read than the average Joe. The sources mention using different correlation types, like rank correlation, Spearman, which is less thrown off by wild outliers.
Okay, so IC is how good your crystal ball is, even if it's a bit cloudy. What about the N breadth?
N is breadth. It's basically the number of independent bets or decisions you make over a year. The source says it has two parts: making bets across lots of different assets at once, cross-sectional, and making repeated bets on the same asset over time series. N captures the total number of independent opportunities you act on.
And putting it together, IR equals IC CRTFE N. What's the big insight there?
The square root is key. It shows mathematically that your overall skill measure, IR, goes up with your forecasting ability, IC, but also with the square root of how many independent bets you make, N.
So making more bets helps, but with diminishing returns because of the square root.
Well, it means that even if your forecasting skill, IC, is only modest, you can still achieve a high IR, generate significant alpha, if you can apply that small edge consistently across a very large number of independent opportunities, high N.
So being slightly right many, many times can be better than being spectacularly right just once or twice.
That's the powerful implication. It suggests strategies that make many small bets across a wide range of things can be more robust alpha sources than putting all your eggs in a few high-conviction baskets. Breadth amplifies skill, which fits with cross-strategies, trading hundreds of stocks or diversifying across many distressed deals.
That's a really important point. Okay, so you've got signals, you understand IC and N.
Yeah.
How do you turn raw data points into something you can actually use to build a portfolio?
Right? You need to process those raw signals. Convert them into scores you can compare and use. The source talks about normalization.
Normalization, like putting everything on the same scale.
Exactly. Your raw signal might be a PE ratio or insider buying dollars or volatility, totally different scales. Normalization standardizes them. A common way is using z-scores. You figure out the average and standard deviation for a signal across all your stocks, then score each stock based on how many standard deviations it is from the average.
So you see if a stock is high, low, or average on that signal compared to others.
Precisely. Gives you a standardized score around 0. But there are other ways too.
Like what?
The source mentions rank transformation, just turning the value into its percentile rank, like 1 to 99. Or reverse CDF transformation, which uses that rank to find a corresponding value on a standard bell curve. These rank methods can be good if your signal only really works at the extremes, like only the top 10% or bottom 10% are predictive. They can stretch out those tails.
So the best way to transform depends on how the signal actually works.
Exactly. You need to know. Does this signal predict returns linearly, or only when it's really high or low? The goal is to turn the raw number into a score that best reflects the expected return you think is associated with that signal, so you can then use those scores to decide what to buy or sell.
All right, this is great. We've got the structure of opportunities like convertibles and distress, the data backbone, measuring alpha with IC and breadth, processing signals. Let's get into some specific examples now. What kinds of signals and strategies do the sources say quant managers actually use?
Okay, specific signals. The sources cover a few categories. One is based on short-term market moves, specifically short-term mean reversion.
Mean reversion thing snapping back to average.
In the very short term, yeah. The idea is that stocks that just did really badly over the last few days or weeks tend to bounce back a bit, outperform.
Yeah.
And stocks that just shot up tend to pull back. It's often seen as exploiting temporary imbalances or overreactions.
Where does that work best?
The source says it tends to be more effective in less liquid stocks, where prices might get pushed around more easily and take longer to snap back.
But trading really short term means lots of trades, right? Costs.
Exactly. That's the huge catch.
Yeah.
High turnover strategies like this rack up trading costs, fast bid-ask spreads, market impact, especially in those same illiquid stocks where the effect is stronger but costs are higher. It really limits how much money you can actually run with this kind of strategy. The source even suggests using volume-adjusted returns to try and filter out noisy price moves caused by big news that might not revert.
Okay, so a real effect, but maybe hard to profit from consistently after costs. What about longer-term signals?
They discuss several. Insider trading gets highlighted, looking at reported buys and sells by company executives, directors.
Does that actually predict anything?
The source suggests it's pretty informative, especially in companies that are harder to understand from the outside. Maybe smaller firms, ones where analysts disagree a lot, companies with high R&D where value is opaque.
Makes sense. Insiders might know more there.
Right. You can look at total buys versus sells or net activity. The source makes a good point that if multiple insiders are all buying or selling around the same time, that's usually a much stronger signal than just one person trading. They also mention some behavioral quirks, like maybe timing bad news before option grants and good news after.
Interesting. What about signals from, company announcements or analyst reports?
Yeah, they compare management guidance versus analyst revisions. Research suggests the guidance coming from the company itself is often a better predictor than what outside analysts forecast later.
Okay.
And an even stronger signal. When management gives good guidance, and then the analysts follow up by raising their estimates too, that mutual confirmation is seen as particularly bullish.
And things like share buybacks. Companies buying their own stock.
Often seen as positive, yeah. The source says it can signal a couple of things. Maybe management thinks they don't have great projects to invest cash in, so returning it via buybacks is responsible. Or, maybe more powerfully, it signals management thinks the stock is cheap. They're using company money to bet on its value.
Okay, so signals from price action, filings, management words, corporate actions, looking everywhere for clues.
Pretty much. And
Right.
not just in the stock market itself. The sources stress you can get useful signals from other markets too.
Like options or credit markets.
Exactly. Option prices, CDS spreads, they often reflect what informed traders are thinking.
Right.
There's a specific strategy mentioned using the difference in implied volatility between call options and put options on a stock, the CVL-PVL spread.
How does that work?
The idea is, if smart money is bullish, they might buy calls, pushing up call volatility relative to puts. If they're bearish, they might buy puts, pushing up put vol. So the strategy is buy stocks where calls are expensive versus puts. High spread suggests bullishness, and short stocks where puts are expensive versus calls. Low spread suggests bearishness. A study found it generated abnormal returns historically.
Using options as a sentiment gauge for stocks. Clever, but there was a catch.
Yeah, a practical one. While the raw returns looked good, actually making money from it gets tricky because of the cost of borrowing the stocks you need to short, ones with low spreads. Sometimes it's expensive, sometimes you just can't find shares to borrow. That might explain why traders with a negative view just buy the puts instead of trying to short the stock.
Transaction costs strike again. Any examples using totally non-financial data?
Yes, a great one on using industry-specific data from energy markets, tracking reports from places like the IEA, EIA, railroad associations, to forecast supply and demand for oil, gas, coal.
And how does tracking oil inventories help pick stocks?
Well, the example used is the U.S. shale gas boom. Fracking massively increased gas supply, crashing gas prices. Gas competes with coal for power generation. So cheap gas plus environmental rules. Bad news for coal demand and coal prices.
So tracking the commodity directly impacts the companies.
Directly and predictably. Understanding those shifts in the energy market gave you an edge in forecasting which companies would benefit, maybe gas pipeline firms, and which would suffer badly, coal producers. It shows you need to look beyond just the company's financials sometimes.
Definitely. What about getting ideas from Wall Street itself, those alpha capture platforms?
Right, alpha capture platforms. Basically, electronic systems where brokers and research firms share shorter-term trading ideas with clients like hedge funds.
How are they different from regular analyst reports? Buy, sell, hold.
Several ways. The ideas often come from salespeople or traders, not just analysts. They're much shorter-term days or weeks, not months. Less formal analysis, maybe based on market chatter. And crucially, they often aren't subject to the same strict disclosure rules, so they can be shared more selectively.
Faster, maybe less rigorous, more exclusive ideas. Do they help with compliance?
Surprisingly, yes. Sharing ideas electronically leaves an audit trail. Better than undocumented phone calls. The source mentions the Goldman trading huddle issue and fine as pushing firms towards using these platforms more formally. Reduces insider trading risk, or at least makes it traceable.
And the platform data itself can be a signal.
Yeah. You can aggregate all the buy-sell ideas submitted for a stock. The source mentions Thomas's STS signal, which is just the net ratio of buys to sells on the platform, a kind of crowdsourced short-term sentiment indicator.
Wow, quite a menu of signals and strategies. But as you said, none of this works without solid risk management. And the sources say it's way more than just watching volatility.
Oh, absolutely. Risk management is everything, especially with these kinds of strategies. Standard deviation, the usual volatility measure, is useful, but it treats good surprises and bad surprises the same. Investors usually care more about the bad ones.
So what are better measures for downside risk?
One is downside deviation, used in the Sortino ratio. It only looks at volatility below some target return, like 0. The idea is upside volatility isn't really risk, right? Another is maximum drawdown. The biggest drop your portfolio ever took from peak to trough tells you the worst pain experienced historically, used in the Kalmar ratio.
Those sound more focused on potential losses.
They are. And while basic tools like mean variance optimization are common, the sources warn they have limits, especially if returns aren't nicely bell-shaped. Understanding your systematic risk factors, what big macro things drive your returns, is also crucial.
And the sources specifically flag tail risk for hedge funds.
Yes, this is super important for strategies like merger arb, distressed, leveraged relative value. Many of these strategies can have return patterns with negative skewness and high kurtosis.
Okay, break those down again simply.
Imagine throwing darts. Normal returns cluster symmetrically around the bullseye. Negative skewness means you have a fatter tail of throws landing way off to the left, more chance of really bad outcomes than really good ones of the same magnitude. High kurtosis means more throws land right in the center and more land way out in both tails, very good and very bad, but fewer in the middle ground. So more extreme results are more likely than a normal curve suggests.
So these strategies might look steady most of the time, but have this hidden potential for sudden, huge losses.
Exactly. Picking up pennies in front of a steamroller. The sources link this to things like the 2008 crisis, where forced selling and deleveraging caused massive sudden losses across strategies that seemed stable before. Merger arb is described as like selling insurance. You collect small premiums, the deal spread most of the time, but face a huge payout loss if a deal unexpectedly blows up.
With that kind of hidden risk, diversification must be paramount.
Absolutely essential. Diversification helps with regular volatility, but it's critical for managing these tail risks or company-specific blow-up risks, like in distressed debt. You simply cannot afford to have too much exposure to any single position that could crater. The sources really hammer this. Don't concentrate your wealth in any one product, especially these complex ones.
And leverage, using borrowed money, sounds like pouring fuel on the fire with tail risk.
It absolutely magnifies everything. Leverage boosts returns when you're right, but it blows you up much faster when you're wrong. If a strategy has potential for sudden large losses on its gross assets, leverage turns that into a potential catastrophe for your actual capital.
Is there any way to think about how much leverage is too much?
The sources mentioned the Kelly criterion. It's a formula from betting theory, basically trying to calculate the optimal bet size to maximize long-term growth without going broke. In finance, it's used conceptually to think about optimal leverage based on how big and reliable your edge is. It shows there's definitely a limit. More leverage isn't always better.
And finally, trading costs. We touched on them with mean reversion, but they matter everywhere.
Hugely, especially for higher turnover strategies. The sources stress you have to account for all costs. There are the explicit ones, like commissions, easy to see.
But the hidden ones are bigger?
Often, yes. Implicit costs. The bid-ask spread is when you always buy a bit higher and sell a bit lower. That's a direct cost every time you trade. Then there's market impact. Your own trading moving the price against you. Buying pushes it up, selling pushes it down. Plus opportunity cost if you get filled slowly, and alpha decay if your signal loses power as you trade.
And market impact isn't just one thing.
Right. They split it into temporary impact, like the dealer adjusting inventory, which fades, and permanent impact, which happens if the market thinks your trade reveals real information, causing a lasting price shift. Trading big based on a good signal is a real balancing act because of this.
Man, this has been incredibly detailed. It's so clear that finding alpha in these margins isn't just about a clever idea. It's deep data work, complex modeling, signal processing, maybe intense fundamental analysis like in distress, and just super rigorous risk management for things like tail risk and costs.
Absolutely. It takes serious investment in brains and technology. The edge really comes from tackling complexity that others avoid.
So let's zoom out one last time. How do these strategies fit into the bigger picture? Hedge funds, market efficiency.
Well, the hedge fund world is incredibly diverse, as the sources note. The strategies we talked about, convert arb, distressed, equity market neutral, merger arb, they're just examples within that huge universe. Convert arb is usually relative value, distressed and merger arb are event-driven.
And the sources suggested certain types of hedge fund strategies might be more appealing.
Yeah, they made a case for zero beta strategies, ones designed to be uncorrelated with the main markets, like relative value and event-driven. The argument is their potential for stable, uncorrelated returns might be more reliable to get than trying to predict which manager running a directional bet-on-the-market strategy will actually deliver skill.
So it's the diversification and stability, not just raw return potential.
Exactly, building a portfolio with different engines. The sources also quickly contrasted hedge funds with mutual funds hedge funds having more flexibility with shorting and hedging, different fee structures like the 2 and 20 model with high water marks, potentially different incentives.
Which enables them to pursue these more complex margin strategies. Okay, last point. Market efficiency. Does finding alpha in the margins mean markets aren't efficient?
The sources take a nuanced view. They don't quite say markets are perfectly efficient nor totally predictable. They quote research saying markets are predictable to some degree, and that this predictability is actually needed to motivate people to find information and keep prices roughly right.
So inefficiencies exist, but they get competed away.
Exactly. Opportunities pop up, but competition is intense. Any easy money gets arbitraged away fast. To consistently profit, you need a real, durable edge, better info, better tech, unique skills. That's where the economic rent comes from.
And market structure changes can affect this, like decimalization.
Yeah, lower trading costs from things like decimalization might make some previously too expensive strategies viable, but they also increase competition for those smaller profits, potentially making things more efficient in those areas over time. It's always evolving.
They even mentioned portable alpha briefly, separating alpha from beta.
Right. Advanced concept.
Yeah.
Idea is to capture a manager's skill, alpha, in one market, then use derivatives like futures to bolt that alpha onto the market exposure, beta, you actually want in your portfolio.
So get bond alpha, but put it on an S&P 500 beta.
That's the concept. Isolate the skill, apply it where you want the risk. But it has costs and complexities, like managing derivatives and counterparty risk.
This deep dive definitely went deep, far beyond the usual market talk. We've seen how investors hunt for edges in places like convertibles and distressed debt, how vital data infrastructure is when data's messy, how alpha is measured via IC and breadth, the power of many small bets. We looked at all sorts of signals, from insider trades to energy reports to option vols, and really hammered home the need for sophisticated risk management beyond just volatility.
It really does show that finding alpha, especially out in these margins, isn't luck. It's intense expertise, rigorous analysis, handling complexity, managing tough risks. It's applying skill where competition might be lower, but the hurdles are definitely higher.
It leaves you wondering, though, doesn't it? With all the data now, all the computing power, all the money-chasing returns, are these margins just shrinking? Are these opportunities disappearing?
That's the huge question, isn't it? Does technology make everything transparent and efficient? Or does the increasing complexity of finance actually create new margins, new puzzles that only the most sophisticated players can solve?
And what about AI analyzing weird data? Or totally new market structures? Will the margins just keep shifting to the next frontier?
It's an ongoing arms race, the search for alpha. The battleground keeps changing. These sources gave us a great look at how the fight plays out in some specialized arenas today.
Absolutely. Well, thank you for joining us on this exploration of finding alpha in the margins. We hope digging into convertibles, distressed, data, signals, and risk gives you a richer view of these complex parts of the investment world. Keep exploring.
And keep asking, where might the next overlooked opportunity be hiding?